Hello, everyone. Today we will explore a critical aspect of financial literacy wealth preservation. It's not just about making money or even saving, but ensuring that your hard earned money not only just remains safe but also grows steadily. We will cover these three topics and strategies of risk management, diversification, and inflation protection in this topic. By the end of this module, you will understand how these concepts work together to secure your financial future. Let's begin with risk management. Risk is simply the chance of losing money. Risk by itself means chance. Every investment carries risk, whether it's in investing in stocks, bonds, real estates, or even keeping cash in your bank. Some risks are big, like losing your investment in a startup, while others are smaller, like the risk of inflation eating away your savings. A good risk management is about understanding and balancing these risks. This is like driving a car. You know there is a risk of accidents, but you take precautions, wearing seat belts, driving carefully, and buying a car insurance policy. Similarly, in finance, we protect ourselves through strategies like insurance, setting aside some emergency funds, and not putting all our money in one high risk investment. Imagine Rohan, a young professional. He invests all his savings in a friend's restaurant business. If the business fails, Rohan could lose everything he has saved. If Rohan had used risk management, he would have spread his money across safer investments like mutual funds or fixed deposits while investing a smaller amount in the restaurant. Next is diversification, one of the most important strategies for managing risk. You've probably heard about it. Don't put all the eggs in one basket. In finance, this means you shouldn't invest all your money in just one type of asset class or one type of stock. Diversifying means spreading your money across different investments. So even if one fails, others can make up for the loss. For example, if the stock market goes down, but you're also invested in real estate or gold, your total wealth remains still stable. Each asset class performs differently based on the economy, which helps balance risk. Let's talk about Anjali. She invests 50% of her money in stocks, 30% in government bonds, 20% in gold. If the stock market crashes, her bond and gold might still hold value and reduce her losses. That's the beauty of diversification. Now let's talk about something interesting. We heard about it earlier. We understood a little bit about it. It's called inflation. It's the rise in prices of goods and services over time, and it can quietly erode the value of your money. What you could buy for 1,000 rupees today might cost you 1,200 in a few days or years or months, meaning your savings are worth less. To protect against inflation, you need to invest in assets that can grow faster than inflation. Keeping all your savings in bank account with the interest rate of 4% isn't enough to beat inflation, which is at 6%. You're actually losing your purchasing power or the purchasing power of your money. Consider Suresh, who puts all his savings in a fixed deposit earning 5%. If the inflation is 6%, his real return is negative 1%. To beat inflation, Suresh could invest in assets like gold, real estate, or which could grow faster over time, or inflation-proof bonds, which are issued by companies or by government. So how do you bring all of these strategies together? By managing your risk, diversifying your investments, and choosing assets that protect you from inflation, you create a strong financial foundation. You might invest 30% of your money in stocks for growth, 30% in bonds for stability, 20% in real estate for inflation protection, and 20% in gold to hedge against market fluctuations. This way, you are prepared for different economic conditions while minimizing the chance of losing everything. Let's look at real-world example during 2008 financial crisis. If you heard about it, I'll encourage you to read more about it. 2008 financial crisis. Many people who invested only in stocks saw their wealth wiped out, but those who diversified in bonds, gold were better protected as bond prices rose and gold maintained its value. This shows that spreading your investments and protecting against inflation can help you even major financial storms. A quick summary for all of us. Risk management, it's a balanced risk with safety nets like insurance and emergency funds. Diversification, spread investments across different assets classes. Inflation protection, choose assets that grow faster than inflation, so that like real estate, gold, stocks. To wrap up, wealth preservation is about smart decision making. Managing your risk, diversifying your investments, and protecting yourself from inflation are essential strategies that will ensure your money not only stays safe but also grows over a period of time. Whether you are just starting out or already building your portfolio, these principles will guide you in long-term financial stability. Now that you know how to preserve your wealth, take a moment to evaluate your current savings or investments. Are you diversified? Are you prepared for inflation? Start applying these principles today and set yourself on the path to financial success. Stay informed, stay protected. Wealth preservation is the key to success.